Dear listeners, welcome to Mark's Morning Call, real time, real markets.
Good morning, Mark.
Good morning, Jennifer.
We are now several weeks in the InvestUp challenge. How do you feel about students' confidence in selecting their stocks compared with first week?
Step by step, we took the decision that we wanted students to get going and make some stock selections, even if they didn't feel confident to do so. And obviously, the plan is each week we kind of add to their tool bag such that they start feeling a greater degree of confidence based upon understanding performance of companies. And then the crucial element that came in last week was then the main valuation criteria of PE. So step by step, I'm hoping that the students feel a little more confident.
Absolutely. The PE is one of the important tool that we often use to compare the price of the stocks. As we said, the stock price itself cannot be compared, but if you actually using their PE, price to earning ratio, we can compare them. So today, let's move on to another important investment tool as dividend yield. We said when we invest to buy stocks, we want to make money. So besides the price going up, we earn the capital gain. We also have returns in the form of dividends. Company do pay us dividend, just like a bank pay us deposit interest. But for those who pay the dividend, it varies a lot. How can we read the signals from dividend payment of the company and make our investment decision? That's my today's main topic.
Yeah, I think that dividends are a crucial part of the investment criteria for a lot of investors. So if we just take a little step back for a moment, then we discussed at some length that the earnings or the net income of the company was how much was generated for the benefit of shareholders. And then if we divide that by the number of shares, we get to the crucial and critical measure of EPS or earnings per share, i.e. how much earnings you get the right to as a result of owning one share. The key now is to kind of say, well, what are they actually going to do with those earnings? So they've generated their earnings. We said they're yours as a shareholder, but what does that actually mean?
Yeah, I had a notice this morning that my bank, so I bought National Australia Bank NAB, they sent me letters saying that they just paid 85 cents dividend per share for my holdings. So obviously I was quite happy at the beginning because, since COVID, they didn't pay much during COVID, but now they're steadily growing their dividend payment.
Yeah, and we're seeing that quite a lot with another number of companies. But in general terms, then once we've got our earnings per share or EPS, the decision is, do I keep it in the company? Do I invest it in order that the company can grow? Or do I pay it out to the shareholders? And so, not surprisingly, that varies massively from company to company, depending upon what opportunities they have to do with that money. So typically, would find that tech companies that have enormous amounts of opportunities to reinvest in order to grow their business in the future tend to pay very small amounts of that EPS by way of a dividend, whereas companies that really haven't got much to do with it tend to kind of pay quite a high proportion. And the key measure that we use in order to differentiate those companies is what's known as the payout ratio. So the payout ratio is just the proportion of how much of the company's EPS is paid out by way of a dividend and is typically expressed in a percentage.
Okay, so I just had a look based on your introduction. My bank actually paid out 74% of their net profit, which is EPS, to the shareholder as dividend. So according to the logic you just introduced, that means the banks paid doesn't have much growth, right? That's why they choose to pay out to the shareholders.
Yeah, I think that with the banks, not just in Australia, but also it's very much the same in the UK, where you have similar kind of payout ratios for HSBC, for Lloyds Bank, for NatWest. You find that they have really not much to do with that capital. And so as a result of that, they're better off paying the shareholders rather than kind of retaining it and just kind of without any kind of clear plan in terms of what to do with it.
Yes, it's always my question. So as an investor, should I aim for high dividend company or low dividend company? Because
Well, it really
at the
depends.
end, I want to make money, right?
Yeah, but the thing is, you can make money in one of two ways. You can make money either because the company's investing and growing, and so therefore is enjoying capital appreciation, or you can make money by way of a dividend that they're paying out each year. I think that in terms of the start point to thinking about dividends is really the type of investor you are. So typically, come or investors who are looking for a dividend are looking for an income-based fund or an income-based investment. And so the actual regular payment of that dividend to them is very important. And so as a
Mm.
result, they need to make sure that that dividend is reliable.
Okay, so for who actually trade dividend like their salary, like retirement people, no income, that's actually quite
Yeah, I
essential.
think that's absolutely correct, is that you tend to find that people who need that income, great example is in fact the fund I run for my mother, then we need to make sure that there is quite a lot of dividend stocks or dividend companies in that portfolio because she needs the income in order to pay for her old people's home. And so the stocks that we tend to kind of focus on in that is not exclusively dividend stocks giving an income, but those that pay out a regular dividend. And so each month she'll get a dividend from some of our holdings. I don't know if it would be useful if I give you some examples, but as you just mentioned, banks really, quite nice profitable businesses right now, but really limited growth opportunities. And so the main way in which banks use their money is to lend out money for people to buy homes. The number of new loans that they're lending out for new homes is quite modest, not growing very much. And so they really have no great need to kind of retain any money in the company over and above what they've got already to grow their business. And so typically UK banks will be paying out a very high proportion of their earnings.
Yeah, I checked. HSBC pay about like a 50% of their earnings out as well. And
Yeah.
I remember on LinkedIn post, you mentioned a quite good company called BAT, and not only has very good dividend, but also consistently paying out. Because I remember COVID, my bank actually really almost dropped to half of their dividend. But your one, they are really consistent for quite a long time, like
Yeah, and when
25
you're
years.
looking at dividends, it's not just the current dividend they're paying, it's also making sure that you're confident that they're going to be able to pay that dividend out in the future. So always make sure you go back and look at the consistency of the dividend payment and think about the type of business it is. I.e., is that business strong enough in order to make sure that it's generating enough earnings to consistently pay that dividend in the future? And so the big mistake you can make is you look at the current dividend and think, oh, that's quite nice.
But a small downturn in their business, and all of a sudden they cut their dividend.
So as a result, that income stream upon which you thought you were relying is actually not that reliable. And therefore, you perhaps were better off putting your money in the bank.
I also have another question which always I couldn't understand. So we just discussed what is dividend, and the dividend is a payout part of their EPS. But now there is another concept called dividend yield. And they use
Yeah.
the dividend payment divided by current share price. That's the part I don't get it. So I give you example. My bank, they're paying $1.7 per share in 2024 based on their share price. The dividend yield is 3.81%. But my question was, I actually bought them pretty cheap. Not last year's price, like $30 per share. I bought at $17 during COVID time. My dividend yield is not 3.8%. I always intrigued to understand why they use current year dividend and divide by current price, not my invested cost, because that's my return, right? Dividend yield is my return.
Well, let's step back and just perhaps think a little bit more about the dividend yield and the calculation to make sure that we're all clear on what that is. And then we'll address kind of the point you raised. So the dividend yield, as you quite rightly say, is the dividend per share divided by the current share price. And so what it's really doing is saying if you were to buy that share today, and if that company was to continue to pay that dividend, that would be the yield you would get based upon today's price. And
Mm,
always when you're thinking about making an investment, you're always kind of thinking about what I can get it for today. The fact that you were
mm.
lucky enough to have bought it 3, 4 years ago is a bonus. But when you're
Ah,
thinking
okay.
about the return that it's generating you, then always what you're thinking about is, am I still better off keeping my money in that stock, your Australian bank, or can I deploy it somewhere else for a higher return? And so the dividend yield, like any other yield or any share price, is a dynamic measure, which is always trying to capture what is the return were you to do something today. Because remember, as an investor, you're always in a position where you can do something today.
Okay, this is like today, if I face all different choices, I used stocks dividend yield so I can compare.
Yeah, so you may, when you bought it, have got a dividend yield based upon the price you paid of 7%,
Yeah.
but that's not really relevant today. You're kind of now saying, right, okay, shall I keep it or shall I sell it? Now the dividend yield is 3.8. So if another bank, which you think is equally as kind of good, is paying a dividend yield of 6%, you might say, okay, now's the time to sell. And what I'll do is redeploy that capital at a higher yield based upon today's prices.
But the condition is I am looking for income. Reason is the Australia bank's share price actually goes very high this year. Example, in early this year, in January, my stock is $37. And now, just 10 months in, it's $44.6. It actually 20.5% up. So
Mm.
when I look at this situation, if I my total return should be 20% price gain plus 3.8% the dividend yield. So it's 23%. It's pretty good for me. But I was just thinking, dividend yield alone maybe not the decision making, right? You have to look at the price potential.
Yeah, like in all investment decisions, then, with just because you are buying the stock because the dividend yield is attractive, then that doesn't mean to say it's the only return. They're still capable of capital appreciation by the stock price going up in the same way that any other stock is. But what I would say is that with stocks that have a high dividend yield over the long term, then a higher proportion of your total return, both from capital appreciation and from yield, will be in the form of yield. Whereas obviously, if
Mm,
you're comparing it against a stock that doesn't actually pay any dividend, then the only return you can possibly get is through capital appreciation, i.e., the share price going up. But typically, you'll
mm.
get a balance. And also, there's an interesting point you've raised about banks, because banks, both in Australia, in Europe, and in the US, have done pretty well this year. And I think there's a couple of things which are worth looking at and considering in that regard. Number one is that the yield, particularly in Australia and the UK, is very attractive and much higher than one can get in the bank or in government bonds. And so as a result, it attracted quite a lot of capital because of the yield support or the appeal of the yield. Also, I think it's worth noting that for this current year, banks have done pretty well because of the fact that they've been able to get deposit money for investors quite cheaply. But long term rates have stayed pretty high. And so, as a result, as we discussed in the banking podcast, the spread between what they lend at and what they kind of get their money for is pretty attractive right now.
Mm. Okay, their business actually making more money by what you
Yeah.
say.
So banks in this environment tend to do quite well. And so the share price goes up as well as the dividend yield being attractive. But always remember, Jennifer, that when the share price goes up, then because the dividend yield is just the dividend per share divided by the share price, then as the share price goes up, the dividend yield will go down. And so for anybody buying in today or now compared to 6 months ago, they're accepting a lower dividend yield than those who were bought at the start of the year.
Yeah, that's the part, it's always a changing equation. It makes the dividend yield comparison quite tricky. I had a look of your UK market that I wonder top 10 dividend yield stocks in the UK, who are they? So the top one was a company called MNG. They are paying dividend around 9.2%.
Yeah. M&G, if you look in the UK market in the FTSE 100, there are, as you quite rightly say, some significant companies that pay big dividends and therefore are still trading on a pretty attractive dividend yield, either high single digits or in the case of M&G and Phoenix, getting up to almost 10%. And it's always a great mystery to me that people don't look at those businesses and the dividend yield as an alternative to shoving their money in the bank, because the compounding effect or the cumulative effect of getting a 10% dividend yield over a long period of time is very significant compared to getting 3 or 4% in the bank.
Exactly.
The other thing I would also say is that if you look at the types of companies in the UK who are paying a high dividend yield, they tend to be quite similar. So their activities are in insurance, in pensions, quite stable, quite solid. There's Phoenix, there's M&G, there's also Aviva. That causes me a little bit of a problem in the sense that when you're obviously buying companies in the same level, the same activities, the same industry, the same sector, you build up quite a bit of systematic risk. And so as a result,
Mm.
even though individually the dividends are attractive, it's sometimes quite nice to find companies who are also paying a high dividend yield in different areas, which is, and you mentioned them a moment ago, BAT, British American Tobacco, is obviously, as the name suggests, maker of tobacco products and vapes. And they have consistently been a big dividend payer. And I don't think they've missed a dividend for 20 years. They're very kind of transparent around the dividend they pay. But again, like you were saying with Australian banks, they've done pretty well this year. That stock is up 40% year to date, outperformed the Mag 7 in terms of stock price appreciation. And the dividend yield has gone at the start of the year from about 9% down to, I think, about 6.8 now. But for me, a 6.8% dividend yield on something that's very cash generative is pretty appealing.
Well, definitely. The other day you talk about the energy stock, the BP even paying dividend yield around 6.5%. That should be a great stock with
Yeah, and
dividend.
BP, I think, is a great story. There's lots going on. I think we mentioned in a number of areas, certainly on LinkedIn, around a kind of energy super cycle triggered by the energy demands of AI, means that the energy requirements of the world in the coming years is just enormous. So that's a big driver for me of energy demand. And the great thing is with BP is that, given, as you quite rightly say, it's got quite an attractive 6% yield, then even if I don't get the huge growth that might come through as a result of the energy demand, I still get a 6% yield sitting there, which is quite attractive from a very large company like BP.
Yeah, so we just talk about the dividend yield. When we say high and low, the benchmark, shall we compare it with like bank deposits rate?
Well, I think as a professional investor, you would tend to benchmark off long term government bonds, which in the UK at the moment for a 10-year bond, you're guaranteed a return for 10 years of 4.7%. I think in the US, about 4.2%. Europe varies a bit between different countries. So in France, then it's about 3.8 right now, Germany a little bit lower. So each country has its own benchmark. But
Mm-hmm.
if we just focus on the UK right now, then 4.7% is what I can get from buying government bonds. If I go and buy a bank product which locks my money into a deposit account, say for 12 months, then I think I'm getting about 4.5% right now. So you can see that the dividend yields are actually more attractive from an income perspective than just plonking your money either in government bonds or in a bank deposit. And so I would use that as my benchmark. And obviously, the greater the spread between the dividend yield, i.e., how much more I'm getting over and above the bank deposit, the more attractive it becomes. Also, bear in mind is that if I plonk my money in the bank at 4.5%, it can never grow. So if I put £1,000 in at 4.5% at the end of the year, it's still £1,000. With someone like a BAT, as I mentioned a moment ago, I get my dividend yield of 6.8, so I get more income, but also I have the possibility of making capital appreciation. But equally, my £1,000 may depreciate because the stock price may go down.
Yeah, so the price capital gain can become capital loss. That's why it's bit more risky than the bond.
Yeah, but as a long-term investor, if all you are genuinely interested is just the income, if I'm confident that British American Tobacco will always pay out that dividend, if I invest £1,000, the yield is 6.8%. I know I get £6.80 of income each year, regardless of what happens to the share price.
Okay, so the good stocks are those people who can constantly pay out the yield a little bit higher than our deposit rate or government bond rate. Meanwhile, they have a steady growth business to give us price appreciation. So we have double benefits if you buy stocks,
Exactly.
right?
And you can see, therefore, why for a number of investors focusing on the dividend, and just to kind of sum up, I guess, the areas we've covered today is really around how reliable is that dividend.
Yeah.
Just because they've paid it in the past doesn't mean to say it's going to be paid in the future. So, first of all, check how reliable it's been in the past, but then go on to think, is this business good enough to always be able to kind of generate enough earnings to pay the dividend?
Hmm.
Have a look at the payout ratio. Have they got a very consistent, very well publicized payout policy? So, do the board of directors come to the investors and say, we look to pay out this amount of our money, 75% or whatever that might be? And then, once we kind of feel comfortable that that dividend is reliable and sustainable, pair it against the share price to get the dividend yield, and then kind of say, is that attractive as an income investor relative to what I can get either in the bank or in government bonds?
Okay, excellent. I think is the final thing I need to highlight is a lot of companies do not pay dividend. So how
Hmm.
shall we look at this phenomenon?
Well, this goes back to the whole idea of the return or the payout ratio. So, as we said a few weeks ago, when we're looking at net income and earnings per share, that's how much is generated. So, we're then kind of again reiterating saying, does the company keep that for investment or does it pay it out? And
Hmm.
so, the key question that I'm asking as an investor is, do I feel confident that that company is making the right decision by keeping those earnings and reinvesting them in things that are going to grow the company? And if I believe that, then I really am quite happy they keep my money and keep putting it in highly profitable activities. So the big tech companies right now, pharmaceutical companies, I don't really want them to pay out a great dividend, because what it really means is if they pay out a great dividend is that they've run out of ideas. They've got nothing exciting to put their money into. The one thing that I would avoid, however,
Hmm.
and this is really crucial, and these are companies that tend to be really disliked by all investors, are ones where they keep the money and they really don't have anything to do with it. So it's almost kind of like, well, we'll keep the money for a rainy day. So again, it's important that the board of directors of the company have a very clear communication strategy to investors to say, we don't pay dividends because we have so many good projects, and these are the projects that we're going to invest in to ensure that your company keeps growing.
So the key is we trust the company managers when they have their net profit and they look at this money, they will say, okay, I have a better ways to use those money to grow my business. That's why I'm not paying the dividend. That's a good manager.
Yeah, and that you see always, and when and this whole area of communication, which I think we should cover on another podcast at a later date, is so important. How do management communicate their strategy to the market? You know, we said to the students, go and have a look at the investor relations section of a company's website. Someone like Marks and Spencer's is a great example. They're very clear around what their strategy is, what the deployment of their money is, and so investors then can make an informed choice. The companies that tend to really suffer are those that either don't communicate very clearly or they don't deliver on what they said they're going to do. So, good examples are when you have a company that says, right, we don't pay a dividend because we've got so many opportunities. Those opportunities don't turn out to be as successful as the management thought or suggested. And then you tend to see the share price suffer very badly on the back of that kind of disappointment.
Okay, I have another question because we discussed that company do not pay dividend because they have growth opportunity. But if one day one company suddenly start to pay dividend, do you think that will hurt their price because they will switch from a high growth company, high growth, high PE, right? High growth
Yeah, and
company into a slow growth company?
you see that very frequently, and it's part of the evolution of a company. Companies are living, breathing things that change over time. So there's many good examples that we've seen this year where companies were valued on very high PEs or pretty high PEs on the back that they had great growth opportunities. The market then realizes that the degree or the amount of their growth opportunities is not as great as they'd previously thought. And so as a result, what happens is they get what's known as derated.
Mm.
The PE that the market is prepared to attribute to that stock goes down. And I'll give you a good example, and one I think that we've posted on earlier in the course is someone like a Greg's that used to trade on 20 times PE because they were growing, opening new Greg outlets all the time. And then that started slowing up. And so as a result of that slowing up, then the PE has gone down to about 11 times. And so the stock price has depreciated quite substantially. But the good thing is now is that management recognize that they don't have as many opportunities to deploy their cash. And so their dividend payout ratio has gone up, their dividend yield has gone up. And so they've transitioned from low payout ratio with high
Hmm.
growth to higher payout ratio with accepting lower growth.
Now they give you dividend yield, right?
So now the dividend yield is not high, but it's an awful lot higher. And you can see this with many companies and watching that dynamic change. The worst is for companies, and the ones that I really hate to invest in myself are those that are growth stories that stop being growth stories, but the management still believe they're a growth story. So they keep your money, they don't pay it back by way of a dividend, they keep investing, but the return on those investments just get lower and lower and lower and lower until they just run out of anything to spend your money on. So they're just, in those cases, really throwing your money away. And not surprisingly, investors hate that and tend to sell their stocks pretty quickly.
Okay, so my understanding is that the dividend yield we can actually link back with their PE. Normally, higher PE, higher growth. Obviously, payout ratio will be low, so dividend yield will be low. Well, when the company has no further better growth opportunity, they will start to pay dividend. So their dividend yield will slowly growing up. Then we will see their PE ratio actually going down. Am I
Yeah,
correct?
that's absolutely
Yeah.
right. So low PE, high dividend yield, high PE, low dividend yield is a very useful just metric to think about different companies. And then as an investor, you're looking at the company you're interested in and saying which of those categories does it fit into. So if it's not paying a dividend, then is it growing fast to compensate? If it is paying a good dividend, is it cheap enough to justify me buying it?
Yeah, so if investor from both perspective, that at least when I buy some stock, I know why I'm buying it. If it's a high PE, or at least I would expect even higher growth, EPS earning growth. If I'm
Correct.
looking at the income, I'll go for dividend yield, which I for consistency. So we have to know what we are looking for in one
Exactly.
stock.
Final reminder, this podcast is for education only, not financial advice. Our views are our own, and investing always carries risk. Please do your own research.